I'm Jeff Spolstra with Summit Mortgage, and this is Mortgage Points. In this video, I'm going to talk about a investor-specific type of a loan, investors meaning people who want to invest or purchase real estate that they do not intend to live in on their own as a primary residence or vacation home or something, but they're going to lease it out. And this kind of loan is called a debt service coverage ratio loan, or DSCR. Now, why is this particularly useful for investors? Well, a typical investment scenario is somebody wants to buy a townhouse or a condominium or maybe a duplex, triplex, and they intend to rent it out. And so they're going to go get a standard mortgage to purchase it and yada, yada, all that. Well, if you're going to get a standard mortgage, you have to qualify for the purchase on your own. It's your credit, your income, just like buying a home, right? You've got to hit the DTI ratios, including continuing to pay for your own primary residence and or any other investment properties that you might have. So as you acquire investment properties, it gets harder and harder to qualify because you have more and more monthly obligations on your hitting your DTI. You've got more and more loans on your credit, et cetera, et cetera. In fact, there is a limit. Most mortgage lenders, you can only own a maximum of 10 properties before you've taxed the limit. You can't get an 11th property with a standard mortgage, one of which being your own primary residence, perhaps. So DSCR loans avoid all that, because with a DSCR loan, it's the property that has to qualify for the mortgage. Now, what do I mean by that? Well, as opposed to considering your income as the owner in terms of making the monthly payments, we look at the ability of the property to generate enough revenue to cover the debt on the property. How does that work? Well, we're going to look at the anticipated or the actual annual gross revenue, gross rentals from the property. We're going to subtract all the annual expenses, property taxes, insurance, utilities, repairs, blah, 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 all that stuff. We're going to get down to a net operating income. What's the cash left over after all those expenses are paid? And then we're going to divide that by the debt service for that property. So if you've got $10,000 worth of net operating income, I'm just making numbers up here, and you've got $5,000 worth of debt service coverage on an annual or monthly basis, well, then you've got a ratio of 10,000 divided by 5,000, or a ratio of 2. That's your DSCR ratio. That means that the property is capable of generating enough cash, enough income to cover at least twice the amount of money that has to be paid to cover the debt. Well, now that's great, because that's perfect. A DSCR loan, typically you need to have a ratio of, say, 1.2 or 1.25, 1.25, which means the property has to generate a little more net operating income than what the debt service is. You can go lower. There are loans where if the ratio is 1, it's making just enough to cover the debt service, or even slightly below, maybe 0.9. That's still doable in some circumstances. But typically, that DSCR ratio has got to be, say, in the 1.2 and above range. So why is this great? Because this isn't hitting your credit. It's the property that's qualifying. The property has to generate enough revenue. The property has to generate enough income. And that avoids the trap of having too many mortgages on too many properties. There's no 10 property limit or anything like that. We're not hitting the DTI against you with your primary residence or any other properties you own. This is really an ideal loan for investors to be able to purchase an investment property that's going to basically pay for itself. And hopefully provide a little extra money in your pocket. That's what you get when you have a DSCR ratio over 1.0. You're ending up with cash in your pocket after all this is covered, right? So DSCR loans, a great opportunity for investors wanting to purchase investment properties, something really to consider. Again, I'm Jeff Spolstra with Summit Mortgage, and this has been Mortgage Points.